Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, we are back again for another podcast.
Andrew, we are back again for a second time recording today because
I wasn't going to say it, but
I forgot to turn on my microphone for the first one, and we got about 10 minutes into recording this,
and then realized, oh crap, the microphone's not on, and we need to start re-recording it again.
So I would say, hey, it's a rookie mistake, but you know what? This is our 101st episode. We're not rookies anymore.
Yeah.
So.
First time it has happened though. So I must say we've done all right to go through 100 odd episodes without this mistake, but we're on and recording again now.
Well, Andrew, let's get straight into it. What are we talking to everybody about today?
Yep. So today we are back again with another market wrap segment.
Yep.
So doing the rounds of what's been happening over the course of the last month, and what's been happening, from a financial market side of things.
Yeah. So essentially, this segment that we're doing once a month, short, sharp indication of what's been happening over the last month in markets, both in Australia, overseas, US in particular, just to get a large amount of information sort of downloaded into a really quick period of time in terms of where we've come from for the month before and where we're going.
Yep.
Being the month ahead.
Yeah, exactly.
Andrew, kick us off. Where are we starting?
Yeah, so look, starting point as always is kind of in the US. They're the leading economy in the world, and the Fed over in the US, as well as also the European Central Bank, they raised rates by 25 basis points last month or last week actually. So we did see a rate rise.
Mm-hmm.
And it was relatively expected in terms of that was where things were ultimately going to end up from a rate side of things.
Yep. Look, it's interesting to note from the US's perspective in terms of their rate tightening cycle versus what we've got in Australia. And I think this is really interesting to point out because the US usually leads the way in terms of what's happening in a world economy. So you're looking at the United States going, okay, they've gone again another 25 basis points. Does that, sort of signal what's happening in Australia? Just to clarify, maybe there's a few people out there that don't know, but the interest rate lever in America is different to Australia to the extent where mortgages for American citizens are usually taken out on a fixed term basis. So at the start of your mortgage cycle, you'll lock in for 30 years and your interest rate will be the same regardless of what the official cash rate is doing. So if you think about the impact that mortgage repayments have on your household budget, and when interest rates get tighter, what we're experiencing in Australia is we've got less discretionary income, so we're more sensitive to interest rate movements, whereas in America, that's not the case. On the home loan repayment portion of your income, it doesn't have as much of an impact. So they need to go harder for longer in order to get the same results. Yeah,
exactly. I mean, it's kind of like, it's basically a fixed rate mortgage for the life of the loan. So really, all those people that were coming off their fixed rates, in the last 6 months or so that hadn't felt the pinch from a cash flow side of things, with all of the rate hikes that have been happening over in Australia, it's exactly the same thing, but that's basically the entire market over in the States. So really any rate rises are only impacting new borrowers. So new people purchasing properties, which does mean that in order to, bring inflation down and in order to slow down an economy, you have to go harder from a rate hike perspective, because you're not impacting all mortgage holders essentially.
Yeah. And from a signalling perspective, what's the signalling been like from the US Fed?
Yeah, so the Fed really has been signaling in their last meeting that we might be starting to see the end of rate hiking, which is largely underpinned by some of the inflation numbers, which I'll get you to talk through in a second, Bills. But it does mean that there's a little bit more certainty from a market side of things.
Yep.
And we might be starting to see the end of this, really rapid rates of interest increase and interest hikes.
Yeah, I mean, if we go off the data and what the data is looking like, so inflation slowed to 0.165 for the month. So if we annualise that out, we're talking a 4.1% inflation number.
Yep.
So that's not where it needs to be, but it's definitely getting closer and closer and closer every time the data is coming out. So the economy is responding to the rate increases that the American Fed are doing, which means that, are we getting closer to the end of that cycle? The answer is yes. And as a result, obviously the markets have responded positively to that as well.
Yeah, so markets were positive on the month. We saw the S&P 500 grew by a bit over 1%, so 1.03%, which is, the market responding to, perhaps no one wants to call it out, but perhaps we're getting that soft landing, or what everyone is now referring to as the Goldilocks scenario.
I love it how just names come out of thin air, and we've spoken about soft landing,
and it really gets traction as well.
Like it feels like an aeroplane, right? And we're going on a flight next week, so we won't talk about how the plane lands and how it doesn't land. But I remember when COVID hit, and they were talking about the shape of the markets with a recovery, and the Nike tick got traction, which sort of dips down and then goes up quite aggressively. Anyway, it's quite interesting. Andrew, outside of the US, what are we seeing in Europe?
Yeah, so look, Eurozone is looking like they're going through some challenging times. So manufacturing and services has been declining really across the board. So the growth outlook from the Eurozone is really starting to deteriorate. So it looks like Europe is starting to go through some, relatively challenging times. And as a result, really, I guess it is a bit of a concern when you're talking about some of those smaller countries that are experiencing, some real squeeze, in terms of home loans and mortgage repayments, but they all share the global currency. And so, inflation is looked at, on a much larger scale than one individual country, but things not looking quite so rosy over in Europe.
Yeah, I guess if you're a larger nation in the Eurozone, you're definitely advantaged by just your sheer size. Whereas if you're a smaller nation, it does get a lot more difficult. And I imagine that as cycles progress, it's harder entering into those and then coming back out as well too. So,
and that's what a lot of these countries are realizing, that hey, we kind of just get dragged along, and our monetary policy just gets dragged along with the broader zone rather than what actually suits our country, which is having that negative impact as well. But sort of a little bit closer to home, not at home, but a little bit closer, there was some information, or lack thereof information, coming out of China, Bills.
The CCP, so the Chinese Communist Party.
Yep.
It's quite an interesting one. I mean, look, the data that we are getting is that the Chinese economy is slowing, so it's still growing, but not to the rate that you'd expect from an economy that's meant to be kind of the growth engine of the world. But what gets very interesting with the Chinese is the information that comes out. This time around, really light on in terms of detail.
Yep.
Which is quite bad.
Yeah.
And I mean bad to the extent where, we've come to expect that if news is good versus if news is bad versus if it's indifferent, at least it's being told and communicated. Whereas in this instance, we're very, very short on detail. There wasn't much information around stimulus and what they're doing in terms of their economy as well too, which has raised some concerns around, I guess, some of the things that have come out of China before that we've come to not necessarily expect, but things like, somebody talks untoward about the CCP and all of a sudden they disappear and they show up 12 months later.
Yeah.
It's just laughable, but it's not at the same time, because it is quite serious, and the world relies on this information in order to get an understanding of what's happening in global economies, and in particular with the Chinese economy as well too.
Yeah, so really some concern in the fact that there was very little detail, very little information, and so where things are heading, we don't know. I think the world's been kind of expecting some stimulus, and the fact that we're not getting any information on that kind of makes your mind think that, or expect the worst case scenario there.
Well, they say no news is good news, but I think in this case it's actually
it's the opposite. I think
it's the other way around. It's like when your parents don't want to share news with you as a child because you're a child and you're too young.
Yeah.
It's like, no, I'm old enough. We can handle it. So anyway, that's the 360 spin-off podcast.
Yeah, exactly.
It's 360 parenting tips apparently. So look, a little bit closer to home. Some welcome news. The Reserve Bank met on the first Tuesday of August, which was a welcome reprieve to mortgage holders. They've decided to keep rates on hold again, which is fantastic. Hopefully that's a really good indication in terms of where we're at from an economic cycle perspective, in terms of the intervention that the Reserve Bank has had to start impacting and decreasing the inflationary impact of everything that's happened that's led up to this.
Yeah, exactly right. So again, similar story, and haven't really come out and said it. And I think the RBA is very cautious of what they say now after that comment a couple of years ago that rates weren't going to go up until 2024. But
he's never going to live that down.
No, never. But we are starting to expect that rates are starting to peak. Now, whether we're at the peak or not, no one knows. So whether we see 1-2 rate rises until the end of the year and it drops off, or whether we don't see any rate rises is ultimately going to depend on the data. But there is some expectation that we're starting to at least get very close to that peak in terms of interest rates, which should give some comfort to mortgage holders as well. Yeah,
and we'll talk about some of those things that's impacting that as well too. I mean, look, it's driven by the data, but we're getting a bit of a mixed bag of things around rental cost increases, which we'll pivot into to now actually, because that's been a fairly significant one, and energy prices and things like that. But rents have grown by 10% on a yearly basis, which is just it's getting very expensive to be able to rent. I don't really want to comment on people making a decision to rent versus buy and affordability and things, but if you are in that basket, having your accommodation costs increase by such a large amount in a time when there is rising cost of living as well too, or maybe higher cost of living, it does hurt.
Yeah, absolutely. And look, that's a result of not just as a result of, but if mortgage holders are also paying more. So you consider investment properties for people are paying more in order to hold those investment properties as a result of all of the rate rises. Well, they're trying to, offload some of that cost over to renters as well, and try and, balance out their own balance sheet. So it's definitely something that is a concern, because a 10% increase in the rental market is massive. Like, we're talking about a fairly significant amount, but when you kind of take it in the broader context of mortgage holders are also paying significantly more from a mortgage side of things, it starts to explain itself a little bit more in terms of the data.
And on that point, I mean, look, CPI in terms of where it's come out. So for the quarter, it's eased to 0.9, which is great. So on an annual basis, we're looking at 5.9%. So it is definitely heading in the right direction, which is great. And that's not a very big surprise that these interest rate increases are starting to have their desired effect. It's decreasing the amount of disposable income that households have got. So they're making decisions on how they deploy that, which is really relevant, I guess, for our next point around retail sales. Yeah,
so retail sales were very disappointing. We did see some not so good data, but I don't know, it depends on which way you want to look at it, right? Like, retail sales were down significantly, which was obviously disappointing for the retail industry, and especially some of those stocks in that segment. But you kind of take that with the consideration around inflation and getting inflation under control. Well, that's one of the things that it means that the interest rate rises are having their desired effect, and people are not going out and spending as much as they were, which will no doubt, bring down inflation over the long term as well.
Yeah. And Andrew, from a global perspective with disinflation, what are we seeing from that perspective?
Yeah, so energy prices, the cost of food is all starting to come down, which is kind of a good sign in that, what we're seeing broadly speaking from most economies is a period of time where interest rates have, increased significantly. Inflation has been extremely high. And so, the concept of avoiding a recession was a very, 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 small possibility of happening. But what we've now seen is markets have continued to rise. Inflation is starting to come down, and we may have peaked in terms of interest rates, which when you look at that fact, it paints a rosy picture in terms of, the broader economy. But the thing that sometimes people forget is, okay, but what's the lag effect of all of the stuff that we've done? So definitely not out of the woods, and I wouldn't be saying that, everything is rosy and everything is great because it's pointing in the right direction, but it is pointing in the right direction.
Yeah, and I think, look, you can't expect that things are always going to be rosy. And, we've got a bit of a saying in our business and stuff, but you can't participate in the game only when the weather's good.
Yeah.
If you're going to do it, you have to expect this, and it's a natural part of running and managing an economy. And look, all in all, the interest rate movements in particular, because that seems to be the largest tool in the Reserve Bank's arsenal in terms of what they're doing, is working.
Yeah. So
at least the market, at least the economy, at least people are responding to what's happening.
Yep.
And we're starting to see, and look, it'd be nice if it was just flick a switch and it has the desired impact the following day, but it is working. So it's encouraging to hear the RBA probably being a little bit more conscious around their language around, hey, we're going to do what the data tells us. So They're not putting out these big statements where, rates aren't going to go up or go down or whatever it may be. So, which
ultimately led to Philip Lowe losing his job, and I think this was his last. Was it his last
one?
Yeah. So won't be seeing any more of him when the RBA announcements come out next month.
This is true, and hopefully the new governor doesn't make the same mistake, which I'm sure she will not.
Yeah.
And Andrew, I think that pretty much wraps us up. I definitely need another coffee because I called it disinflation before, where I was meant to say deflation. But definitely time for another coffee for me.
Yeah, exactly.
Thanks once again for a great podcast.
Thank you, Bills, and thanks very much to all of our listeners and all of our viewers. Hope that that brought some value around what's been happening from a market side of things. And if it has, please like and subscribe.
Catch you on the next one.
Bye.
Thanks.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.